In this video, I discuss the average net worth of a 60-year-old as of 2026. Coming up next on Holy Schmidt.
Holy Schmidt!
If you've spent any time looking up the average net worth of a 60-year-old, one thing you'll notice is that there are a lot of articles out there about this subject, and I mean a lot of articles. And each one of them tells a slightly different story. Some say that the average net worth of a 60-year-old is $250,000. Some say $500,000, some say $1 million plus. It depends on the article. So which one is correct? Let me start off by telling you why that happens, and once you understand why that happens, the rest of the video and future articles, for that matter, will seem a lot more intuitive to you, because most of the time the writer isn't just being sloppy, they are using a different methodology than a different writer. Some articles are reporting the average net worth. Others are reporting the median net worth. Some are reporting the net worth per household. Others are reporting the net worth when you take your house out of the equation. And so unless you have the detail, the number you're looking at doesn't make a lot of sense. But here's what's really interesting about this. Even though you have vastly different numbers, most of those articles are pulling their data from the same source, the Federal Reserve Board's Survey of Consumer Finances. And candidly, it's one of the best sources for this type of information. In fact, it's the gold standard. They're independent. They're not trying to get you to buy their mutual fund. They use thousands of participants to get true averages and two means and two medians. And most importantly, they have the backing of the federal government in terms of the amount of money that they spend to gather the data and to make sure that it's accurate and independent. So the problem isn't the source. The source is excellent. The problem is that it only comes out once every 3 years. The newest data is already 6, 8, 10, 12 months old in many cases. And if we're looking at a report from several years ago, because it's only released once every 3 years, the information could be up to 4 years old. A lot can happen in 4 years. The most recent survey of consumer finances came out in 2023 with 2022 data. Now think about that for a second. It's 2026, at least as of the recording of this video, and so 2022 was 4 years ago. Think about what was happening in 2022. First, inflation was running at 8%. Second, interest rates were skyrocketing because the Fed was trying to control inflation. Third, Russia was invading Ukraine, and so the world felt a little bit dangerous, and markets were plummeting because of all of that. Gas prices were going up, grocery prices were going up, and most Americans had never seen that type of inflation because, frankly, the last time we had something that was north of 8% was 40 years earlier. The Vanguard 2030 fund was down 16%. Now, what's the Vanguard 2030 fund? It's a target date fund, and that date, 2030, is the date that the investor is expecting to retire. What's 2026? And if the average 60-year-old is looking for a fund that will approximate when they retire, the 2030 fund is going to be the one they're probably going to choose. We'll talk more about that in a moment. And the Vanguard 2030 fund, down 16%, wasn't alone. The other mutual fund companies, the big ones, T. Rowe Price and Fidelity, for example, both have 2030 funds, and they were down between 15 and 18%. So it seems like they were all investing in the same type of investments. In other words, 2022 was one of the worst years for a retirement portfolio since 2008. And on top of all of that, we were just coming out of a global pandemic, and the world looks a lot different today in 2026 than it did in 2022. And home values are higher today than they were in 2022. So if the Federal Reserve was taking a snapshot of the typical 60-year-old's portfolio in 2022, the picture would be at a low point. So benchmarking your net worth against 2022 data is a bit like agreeing to sell your home in 2026 for its value back in 2022. Nobody would ever agree to that because, for the most part, home prices have continued to go up. Now, unfortunately, the Federal Reserve hasn't released its 2026 report. It's done the measurements through 2025, but that data is now being compiled, and it will be released within the next 6 months or so. So what's the next best thing? Well, we can take the data from 2022 and adjust the individual components individually, because we do have that data. So the complete picture we have here is as of March 2026. And with these adjustments, we can form a very sensible view of what the average net worth of a 60-year-old is as of March 2026. The first adjustment we're going to make is home equity, because there's been a pretty big spike in the price of homes. If you remember, in 2022, interest rates were going way up, and mortgages went from 3% to 7% within just a few months, and there was a corresponding decline in home values, and they've been moving back up since then. We're going to use the Case-Shiller Home Index, which is the most followed index that we have, and it tracks home prices, average home prices, between 2022 and today, all the way through March, by the way. The increase in the Case-Shiller Index from the end of 2022 through the first quarter of 2026 is up between 10 and 11%. So we're going to assume that the home equity portion of the Survey of Consumer Finances report is also up between 10 and 11%. The second assumption has to do with retirement accounts and other investing, and this is where things get interesting. According to Vanguard's How America Saves 2025 report, of the people in this age group who use a single target date fund, about 50% of them are in the 2030 target date fund. 50%. That's not a small number. That's the most popular single fund choice for people in this age group. And the broader picture is even bigger. 84% of all Vanguard 401k participants use target date funds when their plan offers them. So target date funds aren't some niche product. They are the go-to product for Americans when they invest in their 401k. So we're going to use the change in Vanguard's 2030 fund as a proxy to what happened to equity investments between 2022 and 2026 for the age 60 category. From the end of 2022 through the first quarter of 2026, that fund is up between 30 and 33%. And so we're going to assume that the market investments in things like 401ks, IRAs, and brokerage accounts is up between 30 and 33% for the typical 60-year-old. Now, if you take the 2022 numbers, the average net worth of someone between age 55 and 64 in 2022 was $1.57 million. Now, when you make the adjustments for 2026, using the two data points on housing and market performance, that raises the average net worth to between 1.7 and 1.8 million. Now, why am I giving you a range of 1.7 to 1.8 million instead of just saying it's 1.75 million? Well, the reason is that the mean is a much harder number to determine than the median, which we'll talk about in a minute, because the mean includes some very wealthy people at the high end who have investments in things like private companies or in private investments that a lot of people don't have access to. They might have concentrated real estate investments in something besides their primary home. Maybe they have a vacation home. Maybe they have rental property. And so getting really specific would be doing you a disservice, and that's why we're using a little bit more of a range. The median is a much more useful point anyway because it represents the true midpoint. If you have 99 households, the 50th household is the one in the middle. And that's the one where there are 49 households above that point and 49 households below that point. And the one exactly in the middle is a true midpoint, a true median that you can benchmark yourself off of if you want to benchmark. And the number is vastly different. The Federal Reserve Board said the median number for those between 55 and 64 was $364,500, a big change from the 1.57 million we talked about just a minute ago. And when you make the same adjustment using the same 2 points, housing and investments, that becomes $425,000. That's the median number for the typical 60-year-old. Now, to be super clear about what these numbers are and what they're not, they are not the new numbers from the Federal Reserve, but they are using the old numbers and making some sensible adjustments to them to come up with a March 2026 number. The Federal Reserve won't release their numbers until later in the year, but these numbers represent about the best estimate we can have given what's available, and they're directionally correct. So why does this even matter? Why do we spend the time updating the Federal Reserve numbers from 2022? Well, the big reason is if you're benchmarking yourself against the numbers for whatever reason, and a lot of people have a lot of reasons for doing this, then you at least want to come up with something that is most accurate. And by bringing them into 2026 from 2022, you're getting closer. And the second is that if you don't understand the difference between averages, means versus medians, then you're going to be looking at a number that doesn't represent the people that look like you. You throw a few billionaires in the mix, and all of a sudden the numbers get skewed way up to 1.75 million. The median is the honest number. It's the one that most people would want to pay attention to. Now let me give you a quick example of how the mean and the median can tell two completely different stories to illustrate what I'm talking about. Imagine that you have 10 60-year-olds in a room. 9 of them have a net worth of $400,000. One of them, a retired tech executive, has a net worth of $50 million. If you add all that together and divide by 10, the average, the mean net worth in that room with that population of 60-year-olds is $5 million per person, but only one of those 10 is above $5 million. The rest are dramatically lower. So while $5 million is technically the average, the mean, the median is $400,000. That's the point right in the middle. And that represents most of the people in the room. Now scale that up for the whole country. The Federal Reserve Board is sampling thousands and thousands of households, and you might have a few that are so high that they can take the average from 425 to 1.75 million. And that would make most of the other people feel like they weren't where they should be. That's why the $1.5 million number gets repeated everywhere, even though it doesn't describe most people. Besides the fact that it's 4 years old, it is the mean, not the median. Even after 3 or 4 years of strong performance in the housing market and in the investment market, the median average is still $425,000. So if you're 60 and you're somewhere around that number, you're not behind. If you're comparing yourself to the average, the median of the people your age in this country. Now, I want to add one important caveat to this, and that is knowing the median net worth, $425,000, is one data point, but it's not the most important one. There are a lot of factors that change the impact of that number. Where you live, for example, is a very important part of this. How you live is an important part of this. If you live in a single-family home in Tulsa, Oklahoma, you're going to live one way. If you live in a penthouse apartment in New York City, you're going to live another way. The cost of housing, the cost of groceries, the cost of health care vary wildly depending on where you live in the country. And they also vary if you live in a city, a big city, or you live in a smaller town. Two people with the exact same net worth can have completely different retirements depending on where they live. A paid-off home in a low cost of living area can stretch your $425,000 a long way. A home with a big mortgage and in a big city, well, you're going to have a different set of problems with your $425,000. Your health matters, your debt matters, whether you have a pension or not matters, whether you're still working or not matters. All of that is different from person to person. Whether you have kids that need your help, whether you have parents that need your help, net worth is one data point, but it's not the only data point. And here's something that is really important. It's worth saying out loud. Happiness is not directly tied to having multiples of money compared to the person who is next door to you. I personally know people who have tens of millions of dollars. In the banking business in New York, you run into a lot of them. And some of them are pretty happy, but a lot of them are miserable. I also know people that don't have a lot of money, but they are the happiest people in the room, so to speak. And by the way, the research on this is pretty consistent. Once you have enough money to cover your basic needs and a bit more, everything else doesn't increase your happiness a whole lot. Once you cross that line, the things that do move the needle are things like your health, how you spend your time, your relationships. These are the important drivers of happiness, once you've covered your basics, of course. And the whole point of looking at the median net worth is giving yourself a starting point. And once you have your starting point, then you can adjust depending on your specific situation. If you like this video, check out that video, things you can now do once you turn age 65. This is Jeff Schmidt, and I will see you in that video right there.